In today's financial world, traditional asset classes like stocks and bonds and real estate tend to dominate most conversations about wealth building. However, there's one asset class that remains under the radar and one that offers diversification, stability, liquidity, tax efficiency, and unique advantages for business owners. Hi, my name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial in Vancouver, Canada, and we've been working with business owners to help grow and protect and pass on their legacy for almost 15 years. The asset class I'm talking about is called participating whole life insurance, or PAR insurance. Unlike traditional investments that go up and down with the market, PAR insurance provides a stable, tax-efficient way to grow and preserve wealth over the long term. So in this video today, we'll deep dive into why participating whole life insurance is such a powerful tool for successful business owners looking to protect and enhance their wealth. So in today's video, we'll explore how PAR insurance can become a cornerstone of your wealth strategy like it is for hundreds of our clients across the country. And today we're going to go through the content that's been provided by Equitable Life of Canada. So I'm going to link to the full article in the description below if you want to read the full article yourself. But I'm here basically to make it easier for you to understand. So we'll start with what is participating whole life insurance. So participating whole life insurance is often referred to as PAR insurance. It's a type of permanent life insurance that offers both a death benefit and a cash value component that will grow over time. It's not like term insurance, which is also important, but it only provides you coverage for a specific time, so usually 10 years or 20 years. Participating insurance covers you for your entire life, and it allows you to participate in the profits of the insurance company itself through a dividend. These dividends are used to buy more insurance, to reduce your premiums, or to accumulate within the policy and grow tax-free. But what really sets PAR insurance apart is the ability to function as a unique asset class on its own, one that combines the investment growth with the security of life insurance. So why is participating whole life insurance a unique asset class? It's more than just a death benefit. It's a unique asset class with kind of 5 key advantages that can help you to build and protect wealth more effectively than other traditional investments. So we'll break down each of these advantages. Number 1, diversification. So this is a multi-asset approach, right? The cash value of a PAR policy is managed within a diversified portfolio that includes bonds, equities, real estate, private placements, and other things. So for example, we're using the Equitable Life PAR account example right now, and this is numbers as of 2023. They had 34% of the PAR account in bonds, 19% in equities, 12% in real estate, 12% were actually policy loans, 11% in private placements, 8% funding mortgages, and they have about 4% in cash. So this diversified approach spreads risk and has delivered steady returns for about 100 years. So unlike traditional portfolios, which can be heavily impacted by market volatility, PAR accounts benefit from that mix of assets that move independently from one another. This multi-asset approach aligns well with modern portfolio theory, which emphasizes the importance of diversification to reduce risk without sacrificing returns. So we'll talk about the impact of diversification. And let's consider a high net worth individual who's allocating $100,000 annually that they used to have in a bond-heavy portfolio, but they're reallocating it into a PAR policy for the next 15 years. So the diversified nature of this PAR account means that even if one of the asset classes underperforms, the others can offset those losses. So after 15 years, the cash value has grown significantly, offering both protection and growth potential. Unlike a traditional bond portfolio that would have been fully exposed to interest rate risks this whole time. Number 2 is stability. So consistent returns with low volatility. One of the most attractive features of participating life insurance is the stability. And the averaged annualized return of the Equitable Life PAR fund over the last 30 years has been about 7.35%, and with a small standard deviation of 1.79. So this means you get equity-like returns with bond-like stability. So this is something that you can't really find in most investments. So how is the stability achieved? Well, with participating insurance, they achieve this stability through a smoothing process in the dividend scale interest rate. So by using a move to market approach, the insurer can pass through gains and losses over time, and this provides a more predictable return. So basically, in good years, they don't pay out all the gains, and in down years, they top up the gains. So you have a very smooth return over time. And then this approach means that even in market downturns, the impact on your cash value is minimized. And then let's explain what's called the efficient frontier. So in investment theory, the efficient frontier represents a portfolio that offers maximum expected return for a given level of risk. So when plotted on the efficient frontier, par insurance shows a high return for low risk compared to traditional fixed income investments. So this makes it an ideal choice for those that are looking to preserve and grow wealth over time. Third, we'll talk about liquidity. So how do you access your wealth without selling any of these assets? Liquidity is critical for high net worth Canadians who want to access their wealth without disrupting the long-term investment strategy. So with a participating insurance policy, you have multiple liquidity options. So number one, you have policy loans. So you can borrow against the cash value of your policy at competitive interest rates without triggering a taxable event, so without having to withdraw the money. And the borrowed funds can be used for whatever you want. So you can invest, you can buy real estate, or you can manage cash flow in your business. Secondly, you have cash surrender value. So if you need, you can surrender the policy and receive all of the cash that's in it, your cash value. Although this option might incur taxes, and we generally don't recommend it, but the option is there. And some people really like the fact that, if everything goes wrong, they can just cancel the policy and get all their cash. Third, you can do what's called collateral loans. So we do this a lot for clients. Many financial institutions like banks accept the cash value of a par policy as collateral for loans, which lets you leverage the policy without having to cash it in. Now let's talk about liquidity versus other traditional investments. So when it comes to managing your wealth, liquidity, or the ability to access cash quickly without a significant loss, is a critical factor. So traditional fixed income investments, which would be bonds or GICs or maybe dividend paying stocks, they often require you to sell the asset so that you can get the cash. So this process can do a few things. It can trigger capital gains, and it's also going to disrupt your investment strategy because you now aren't invested, you took the money out. In a high tax environment like Canada, these tax implications can significantly erode the value of your investments, and it makes it harder to achieve your long-term financial goals. So for example, if you need $100,000 and you've got traditional types of investments in your portfolio, you might have to sell a portion of your holdings, realize the capital gain, and pay the capital gains, which could be up to 26% in certain provinces, right? So this means you lose $26,000 to taxes alone, not to mention the impact on your overall portfolio balance and your long-term compounding potential. Further, selling fixed income investments prematurely can expose you to interest rate risk. So you might be forced to sell or to liquidate bonds at a loss, even if market rates have risen. So we'll contrast that with participating whole life insurance, which offers a much more tax efficient and flexible solution for liquidity. So the cash value of a par policy grows tax-free and can be accessed through collateral loans without triggering this taxable event. So you can also access through policy loans from the insurance company, but these could be taxable depending on what's called your adjusted cost base. So these types of loans let you borrow against the cash value at a competitive rate while you keep the underlying investment intact and it continues to compound. So this is a game changer for business owners and for high net worth Canadians who want to keep their investment strategies uninterrupted. You want to keep the compounding going. Fourth is tax efficiency. So you want to minimize your tax burden. And when it comes to building and preserving wealth, minimizing the tax liability is one of the most effective strategies available. So in Canada, high income earners can pay more than 50% combined federal and provincial tax in some provinces. And so having a tax efficient solution is critical. And this is where participating whole life insurance shines as an asset class, right? The tax advantage of par is not just significant, it can fundamentally transform the after-tax value of your estate, it can enhance liquidity, and it can support your long-term wealth building goals. Unlike traditional investments, which are subject to capital gains or dividend tax or interest income, par insurance offers a range of tax benefit that make it one of the most efficient tools for wealth preservation in Canada. So I'm going to talk a little bit about some of these tax advantages now so you can understand why par insurance should be a cornerstone of your financial strategy. So again, one, it's tax-free growth, and you want to maximize your wealth without that tax burden. So one of the most compelling advantages of par is that the cash in the policy grows tax-free when it's still inside the policy. So as you pay premiums, a portion is allocated to a professionally managed investment pool that includes bonds, equities, real estate, private placements like we talked about earlier. So this is the participating fund, and this is what is used to pay your dividend inside the policy. And the gains generated by this diversified portfolio accumulate in your policy without being subject to annual tax. And then why does this matter, right? In traditional investment accounts, such as a non-registered investment account, the capital gains or interest income or dividends, they're all subject to annual taxation. So this not only reduces your overall return, but it also limits the compounding effect of your investments. So by avoiding these annual tax liabilities, participating insurance allows your money to grow faster and more efficiently. So we'll talk about the compounding advantage. So imagine you've invested $100,000 annually into a traditional portfolio versus into a participating account. And you do this for 20 years. So at a 6% annual rate of return, the traditional portfolio would have been subject to annual taxes, and it would have significantly reduced the growth potential. So we'll contrast that, and the cash value in your par policy would grow unimpeded by taxes and potentially resulting in a portfolio that's hundreds of thousands of dollars bigger by the end of that 20-year period. So number two, tax-free death benefit, right? This preserves your legacy without losing a bunch of money. So the death benefit of a par insurance policy is paid out tax-free to your company or to your beneficiaries if it's held personally. So now this isn't special to par. All life insurance in Canada pays out tax-free unless you do something to screw it up, which if you're working with a professional like us, we would tell you not to do those things. The tax-free payout of life insurance is a huge advantage in Canada, where that deemed disposition rule can result in substantial tax liabilities on death. So when someone passes away in Canada, the CRA considers that person to have sold all their assets at fair market value. So potentially triggering capital gains. So that could mean you're going to pay up to 26% in certain provinces. If you have any amount of assets like houses, buildings, cash, investments, this can quickly add up to a lot of money that your estate needs to pay in tax right now before anything can be paid out to your beneficiaries. So life insurance solves this. And you also want to eliminate that tax burden on your estate. So with par insurance, the death benefit bypasses this deemed disposition tax entirely. And this means that your beneficiaries receive the full amount tax-free, allowing them to cover estate taxes or pay off debts, invest the funds, without having to worry about losing a significant chunk to the CRA. You get tax-free access, and so you can unlock liquidity without triggering the tax. Participating insurance also offers this ability to access the cash value of your policy tax-free through either a policy loan from the insurance company or a collateral loan from a bank. So unlike if you withdraw from an RRSP or a non-registered account, policy loans are not taxable unless they're more than your adjusted cost base, your ACB. This makes them an incredibly tax-efficient way to access funds when you need them. Collateral loans from a third-party bank aren't taxable, but you generally have to have a higher cash value inside your policy before the bank will look at you for lending. So depending on the bank, they generally want you to be depositing $100,000 to $300,000 a year into one of these policies before they will set up lending against the policy. Now, how do policy loans work? So when you take a policy loan, you're borrowing from the insurance company against the cash value of your policy. The loan is secured by the cash value itself, and the funds can be used for whatever you want, whether it's to invest in your business or to buy real estate or manage your cash flow needs. You could also take your policy loan money and buy expensive purses and Lamborghinis like all those cool influencers online, but we generally don't recommend that. Since the loan is not considered income, you don't have to report it on your tax return. And when we're talking about collateral loans from a bank, those are completely tax-free. And again, you can use that loan money for whatever you want, but generally the clients that we're working with, we're using it for investment, for business purchases, or for really specific things. And we're generally telling people, don't go gamble this in Las Vegas. With collateral loans from a bank, you do need to pay at least interest-only payments to that bank. So you do need to consider that there will be interest payments, and those interest payments are going to get bigger each year as you take a bigger loan each year. So what's the power of tax-deferred access? In a traditional investment account, to access those funds, it often means you need to sell the assets. So you then realize the gain and you'll pay taxes in that year. So this disrupts the long-term investment strategy, and this stops the compounding of your portfolio. With participating insurance, you can access liquidity strategically and tax efficiently, and ensures that your wealth continues to grow even when you've leveraged it for other things. So we have another video here on YouTube where we dive deep into how policy loans work, and you can click somewhere on the screen right now to watch that video. Number 4, so you want to maximize tax efficiency, especially in a high tax environment. So in Canada, combined federal and provincial tax rates for high income earners can be more than 50%. So minimizing taxes is crucial if you want to build and keep any sort of wealth. The tax benefits of PAR insurance, right? The tax-free growth, tax-free death benefit, tax-deferred access, they make it one of the most efficient tools available for this purpose. Now, how do you integrate PAR insurance into a comprehensive wealth strategy? You really need to have some PAR insurance in your plan with other tax-efficient structures, such as maybe a family trust or an individual pension plan. This can create a comprehensive strategy that minimizes your taxes, maximizes the growth, and ensures a smooth transfer of wealth to the next generation when that time comes. Let's recap. Number 1, you get that tax-free growth. So it accelerates your compounding by avoiding the annual tax. You also get a tax-free death benefit. So this ensures that your company or your family beneficiaries receive the full amount of the death benefit tax-free, and then that can help them, that goes to your beneficiaries and can help them to, pay taxes or live their life. You also can have that tax-free access, so your money can continue to grow, but this provides liquidity without triggering a taxable event. So with the policy loans, they're mostly tax-free until the policy loan gets above your adjusted cost base. When you have collateral loans from a bank, those are totally tax-free, but you need to be depositing larger amounts before the bank will work with you on these. And then number 5, the capital dividend account. This is a huge advantage for business owners. It's a big one, and most people don't understand it, but your accountant should definitely know about this. For incorporated business owners, the benefits of owning these participating policies corporately are even more compelling. So when a corporation owns a participating policy, the death benefit minus the adjusted cost base can be credited to what's called the company's capital dividend account, or CDA. So this allows for a tax-free distribution of capital dividends to your Canadian resident shareholders. So in plain English, this means that the life insurance pays out tax-free to the corp, and then when you pass away, and then most or all of it can pay out from the corporation to the corporation's beneficiaries tax-free. And so let's compare the corporate advantage. So you as a business owner, you hold fixed income assets inside your corporation. So the after-tax distribution to shareholders will be significantly lower compared to if you use a participating insurance policy. The CDA allows the company to pass on the insurance proceeds tax-free, which maximizes the net benefit to shareholders. So if you want to dive deeper into the CDA, we have a whole video focused on that that's on our YouTube channel, and you can click somewhere on the screen right now to watch it after you finish this video. You can also talk to your accountant about how the CDA works and why it's so beneficial for you. So is a participating whole life insurance policy right for you? Well, I don't know. PAR insurance is not a one-size-fits-all solution. It requires proper structuring and a long-term perspective so that you can maximize the benefits. You also have to have an insurance need, or it doesn't make sense. So where it does make a lot of sense is if you're a business owner. So if you're looking for tax-efficient ways to grow, use, and transfer your wealth, It's really good for high net worth individuals who want to diversify beyond traditional investments and who also want to guarantee a tax-free legacy for their kids or family or whoever their beneficiaries are. And for families, if you want to secure a tax-free legacy for future generations. Choosing the right insurance company matters. So not all insurance companies offer participating whole life insurance policies. And the ones that do offer these PAR policies, there are some variances between them. So it's important to work with someone who deals with all the companies and knows the ins and outs of each. So that would be somebody like us, right? Part of the value that we do is placing the right policy for you with the right insurance company. One of the values here at Safe Pacific is our independence. And what does that mean? That means that no bank, no insurance company, no investment company owns us. Nobody tells us what to do. And we don't have any advantage placing your policy with this company versus this company versus this company. We're totally independent. Not all advisors in Canada are independent. Some work directly for a specific insurance company. And generally, when you're working with them, the solution that they're going to present is the insurance company that they work with. And they're probably not going to present you a solution from an insurance company that they don't work with. So you want to work with somebody who's independent and who can access all the different types of insurance companies. And for me, it doesn't matter if you go with this one, or this one, because I get paid the same regardless. So some final thoughts, and this is about building a lasting legacy. Participating insurance offers a unique blend of growth, security, tax efficiency that few other asset classes can match. By implementing a PAR insurance into your wealth strategy, you can do a few things. So you can preserve and grow your wealth tax efficiently now. You can ensure liquidity without disrupting your investments when you need it. And you can provide a tax-free legacy for future generations. We do this all day, every day. So if you want to see how a participating whole life policy can fit in your business or in your family needs, reach out to us here at Safe Pacific. We'll get a good understanding of your current situation, about your goals, your concerns moving forward. And then from there, we'll put together a plan that can help you to hit your goals and alleviate your concerns. The best way to contact us is through the website. It's safepacific.com. You can fill out the form there and somebody will get back to you within 24 hours and we'll set up a time to meet. We work with clients all across Canada. Now, before you go, don't forget to click the like button or the subscribe button. We drop new videos every week that are specifically made for successful Canadian business owners. That's it for me today. I'll see you next time.